Good evening. This is the fourth webinar for today, and today we are going to do expected return and risk. Before I proceed, just to revise what we did earlier, right? We tried to figure out first how you calculate return, right? In a single rate of return is simply the ending value minus the beginning value plus whatever dividends or interest that you get, right? Divided by the beginning value, right? This is in terms of how you calculate your rate of return. Over the years, you can calculate the rate of return over a number of years, and if you want to calculate the average rate of return, all you have to do is simply find out the arithmetic average of all the rate of returns, and you will be able to find the historical return of a security. If you want to find the risk for a particular security, in terms of historical data, you will use something like standard deviation. Standard deviation, as everybody knows, it's relatively very simple as long as you have the average. Suppose you had, let's say, first, second, third, fourth, right? Suppose you had returned 15% in 1 year, 20% in 1 year, 25% in 1 year, and 20% in the fourth year. So you have 15 plus 20, 35, 60, 70. Okay. Now the problem comes is that when you are going to invest in a security, right? There is some historical return and historical risk that is there on the security, but not necessarily that what you have historically will be the return or risk that you will have in future also. Right? So, taking a historical return and risk as a base or a foundation is all right, but if you try and do it in terms of that, this is the actual historical return that I'm going to get at par, so this is actually the return that I'm going to get in future, it actually does not work that way. Right? So in that case, I have to estimate what is the expected return and risk that I'm going to find. Right? So historical is what you say is ex post return, and the expected return is what you call as ex ante return. Historical return is ex post, right? And expected is ex ante. Right? Now, in terms of expected return, for example, at the moment the Sensex has reached 15,000 level. Okay. We are doing relatively well, okay, and we are all pretty bullish on the economy. But you never know. For example, infrastructure may not be doing very well, so we don't know whether this growth momentum is going to continue. Secondly, one can always go to war with Pakistan. We could have an oil crisis. Right? We could have a political crisis. We may, somebody may assassinate the prime minister. Right? So something may happen, right? So there is always a possibility that the growth story may not continue. So what we may have is multiple scenarios. One, you may have a very positive scenario. One you may have is not so positive. One may have a rather negative scenario. So when I construct, expected probability distributions, what I try and do is I construct scenarios. Right? So, for example, if I have a scenario 1, scenario 2, scenario 3, scenario 4. Okay. So, for example, 1 is an extremely optimistic situation where I expect the economy, to go great guns, right? And the economy is going to go great guns, and let's assume that we are having a stock of, let's say, an automobile company, right? So, if we are having a stock of an automobile company and if the economy is doing very well, more people are likely to buy cars, okay? So, in that case, we have the returns on this particular automobile company, and I assume that the returns will be 20%. There is a not so optimistic scenario, which is, let's say, stable. In this case, probably I may just expect the returns to be just 10%. This is, a pessimistic, maybe a 3%. And a bad scenario where we go to war or something. In that case, right? Now, if I look at these scenarios, not necessarily that all these scenarios have equally probable. Some scenarios will be more probable because right now, given the current situation, given the fact that this has reached 15,000, everything seems to be fine. Interest rates have finally become a little stable. We're expecting that interest rates are going to be constant, inflation is under control. So in the next 1 year or so, I would be rather more towards filtered that I will have a optimistic scenario. So what I can do is probably give this, let's say, a 50% weightage, right? This maybe a 20% weightage, and this maybe 70. This may be also 20%. 40, 90, maybe only 10%. So, and this should be equal to 100%. So what I expect is, putting it in a nutshell, is that I expect that I have a 50% chance that the economy will move upwards and the stock is going to give me 20% rate of return. I have a 20% chance that the stock is going to give me a 10% rate of return, a 20% chance that it is going to give me only a 3% return, and only a 10% chance it will give me a negative 5%. Right? So if I want to find out what is the expected return going to be, I would simply multiply the probability with the returns that I am going to expect. Right? So 0.5 into 20 is what?
10.
1. 1?
Yes.
Right? 20 into 0.5 should be what?
10.
10.
10. Right? 0.2 into 10?
2.
2. 0.2 into 3?
6.
0.6.
0.6.
0.10 into minus 5?
Minus
Minus
0.5.
five.
Minus 0.5.
Minus 0.5? Would that be correct?
Yes, sir.
Right? Add it up. I would get 10 plus 2, 12. That's 6.
11.9.
So this will be 11.1. 12.1. Right? So I will get a expected return of 12.1. Right? Now this is how I would calculate the expected return for the coming year. Right? Now please note the fact that I have not divided this by n. Right? Why? Because I am calculating the return for one particular year, wherein I have given probabilities for different scenarios. Right? So the return that I am actually calculating is simply a weighted average of the expected probability multiplied by the return in that particular scenario. Right? So that is why, because commonly we end up making this mistake that we divide by n minus 1. It is not n minus 1, simply because this is the expected return for only the coming year. Right? Now if I had to find the risk, right? In this case, right? Again, this is 0.5, it was 0.2, 0.2 and 0.1. Right? This was the estimate that we had. This was 20%, 10%, and this was plus 3%, and this is minus 5%. Right? This is what we had estimated, and we had an average of 12.1%. Right? Now, for the sake of, in terms of my calculation, comfortableness, let me take it as a round figure of 12%. Okay, just for the sake of making the calculation simple. If I have to calculate an expected risk, right? So what would I have done is I would have found out the expected return, right? Then 20 minus 12 to the power of 2, right, into 0.5, 10 minus 12 to the power of 2 into 0.20, 3 minus 12 to the power of 2 into 0.20, minus 5 minus 12 to the power of 2 into 0.10. This is 8, 8 is 64, 64 into 0.5 is 32, minus 2, 4 into 0.2, is 0.8. This is 9, 81, 81 into 0.20 is 40.5, and minus 17, 17 is 289. into 0.10 is 28.9. So that is correct? Right? Add this all up. What is the answer that you get? 16 point. That's okay, 20%. Yeah, okay. Calculate this. This total it up.
67.9.
67.9. Okay. Now this is in terms of, right, if I total this up, this is the variance, right? And if I find the square root of this, right, I will find a standard deviation, which is the expected risk, right? This is in terms of how to calculate expected return and risk in terms of a individual security, right? Now if I move forward in terms of calculating returns, this is the risk in return, expected return and risk of a single security. Now if I had to calculate the return and risk of a portfolio, right? Let's for the time being think of expected. Right, let's talk about only historical returns on a portfolio. Right? Now, assuming I have two securities, let's say A and B. Okay. Let's say A gives 15% in, let's say, time period 1. B gives minus 20%. This is 20%. This is 5%. This is 10%. Let's see, 30%. Assuming these are the figures that I have, right? Now, assuming that if I form a portfolio, that if I was to invest 50% in A and 50% in B, right? In that case, I would find the average of A and the average of B. Right? There are actually two ways of doing it, right? Either I can find 50% of this and 50% of this and add it up, right? So this is 7.5 plus minus 10, that is minus 2.5, and this is 10 plus 2.5, which is 12.5, this is 5 plus 15, this is 20%, right? This is in terms of, right, and if I'll add up this, right, total it up, divided by 3, I would find out the expected return on a portfolio that is made up of two securities. Right? Okay, just to again repeat what I had done in the last couple of minutes, that we talked about in a portfolio context, right? As I said, there were two particular scripts, right? So depending on whatever was the individual percentage that was invested in the script, right? So there were two ways of doing it, right? Either for each of the periods, I would have found 50% in it and constructed for, let's say, 4 periods or 5 periods. Or I could have found out the average return on, let's say, script A. Suppose the average return on script A is, let's say, 15%, and the average return on B is 20%. So if I had invested 50% in A and 50% in B, so the average return on this portfolio would have been
17.5.
Right? Now, if I change the ratios, so example, if I make this as 40%, right? So 15 into 0.4 and 20 into
18.
Right? So to that extent, again, I would have a different figure. So if I want to find the return on a portfolio, it is simply a weighted average of the proportions that I invest in each of the scripts. Now here I have taken an example of two securities. So any one person, when he holds a portfolio, there are multiple securities, right? When I say securities, it just not means stocks and shares, right? I can talk about government of bonds, I can talk about NSC, I can talk about public provident fund, right? So for example, like if I had, let's say, 20 lakh worth of investments, right? Assuming that if I had 20 lakh worth of investments, right? So I invest, let's say, 5 lakhs in equities, direct equities, another 5 lakhs in mutual funds, another 4 lakhs in, let's say, PPF, or let's say PPF, let's leave it as PPF. Another 2 lakhs in national savings certificates. Another 2 lakhs in post office schemes. Right? That makes it 10,
18.
14, 16, 18. Another 2 lakhs. Right? When you want to, let's say, one market of the funds. Right? Right? This is how I have divided my portfolio. Right? So if I wanted to find out what is the actual return I find on portfolio, so let me figure out what are the returns that I have on each of these securities. So assuming equities, let's say I had 20%, mutual funds 15%, PPF assuming 8%, right? That's what the rate is. NSE 8%, post office again 8%, right? And in this, let's say it's 5%, right? So these figures are not exact, right? But assuming this is, because if I am taking out NSE, so depending on, right, it could be, it's actually 8.25 on the actual rated effective yield is actually 8.25%, right? So in terms of this, right, so here 5 lakhs divided by 20 into 20 plus 5 divided by 20 into 15 plus 4 divided by 20 into 8 plus 2 divided by 20 into 8 plus 2 divided by 20 again into 8 plus 2 divided by 20 into 5. Right? And I would be able to calculate whatever is the weighted average in terms of what is the weighted return that I have on my portfolio. Right? Fairly clear to everybody?
Yes.
Right? Now, calculating returns, I mean, in terms of formula, it will be weight 1 into R1, 2 into R2, and so on. Right? So this would be the return on the portfolio. This is how I would interpret it in terms of a formula. Now, if I were to calculate risk on a portfolio, can I say that risk is actually a weighted average of my individual standard deviations? Can I actually interpret it as that?
No.
Why not? Everybody has a fair idea that everybody is very sure about the fact that risk is definitely not a weighted average of the individual standard deviations. Would everybody agree to that? Right? Are you absolutely confident that it will not be a weighted average of the individual standard deviations?
Yes.
Okay. Okay, now let's take an example. Okay. Let's assume that the average return on stock A is 20% and returns on stock B is, let's say, 12%. Right? And the risk on A is, right, is, let's say, 6, and the risk on B is, okay, it's maybe 4. Okay. Okay, when you say risk, it actually means variability of returns. Okay. See, here risk does not connote any positive or negative connotation. Right? The risk, whether it is going up or going down, right, it is still regarded as risk. Even if the stock is going up, right, it is still risk, right? Simply because risk in financial investment is actually regarded as variability of returns. So anything which is away from what is expected or what is normal, right, is regarded as risk. For example, if you have studied in quantity, you have something like a normal distribution.
Yes.
Right? This is supposed to be the mean.
Yes, sir.
Right? So whether it is lower or upper.
Okay.
Right? So it is minus, whatever standard deviation from here, 3 standard deviation from here, and 3 standard deviations here. It is standard deviation, right? It is deviation from the normal. What I expect a particular stock to be, right? If it deviates from that, right? Now, the reason why we say that if it's going down, then it is bad. See, please understand, is going down from what level, right? Today you bought a stock at 15, right? So your base is 15, right? Now from 15 it goes down to 10, you will say negative, right? But what happens to the guy who bought it at 10, right? It remains as 10, right? Because there are numerous people who are buying the stock and you might have bought it at different levels. And secondly, also there is a possibility of something like short selling. Short selling is basically, you benefit from price decrease rather than price increase, right? Suppose, for example, you bought a stock at, right? Suppose you sold a stock at, let's say, 25 rupees, right? Now, with the hope that you will buy it, you expect the price to decline, you hope the security will fall down to, let's say, 15. So, you sell it for 25, but you buy it at 15. So, to that extent, the difference in price is your gain.
Yes.
So, for my, understanding is that whether you are you actually held the stock or you are a short seller. So, risk has to be interpreted from the where I am expecting it to be, right? If the normal value is this and it goes over and above that, whether it is above or under, it is risk. Right? Does that answer your question?
Yes.
Okay. I think before I actually do the formula, let's actually take a example, okay? We have stock A and we have stock B, okay? We have again time period 1, 2, 3, 4, okay? And let's actually do the calculation and figure out the individual standard deviations of stock A, individual standard deviations of B, and the standard deviation of the portfolio, right? Let's assume the stock has 15%, 5%, minus 20, 20, 20. Right? That's a round figure. Right? This should be a round figure. And this is, let's say, plus 25 plus 5 minus 10 minus 30 minus 20. Okay? Let's have this kind of figure. Right. This is the figures that I have, right? So if I calculate the average of this is 10. Is that be correct? Yes, no, it's right. And this would be 30 minus 10. 20.
0.
0. Minus 30 correct. Or let's do something else. Plus 30. Okay, plus 30. Right, so this is 60, 30 minus 20, 50, 50. Again, it will not have a 12.5. Okay, let's find the 12.5. 50 divided by 4. Okay. Okay, one and a round figure, but we manage this. Okay. Now, suppose I have 50% of A and 50% of B. Okay. So this is 7.5 minus 7.5 plus 12.5. This is what? 5? Right?
Yes, sir.
Then this is minus 2.5 plus 2.5. 0. This is plus 10 and minus 5. 5. And this is plus 20 plus 30. 35. Right? Find out the average. 40, 45 divided by 4.
11.25.
11.25. Right? Now, I would request you to find the standard deviation of A, B, and of this portfolio. Okay? Right? How do you calculate the standard deviation of this? Suppose if I were to do it for A, standard deviation is A, so I will do it minus 15 minus 10 square minus 5 minus 10 whole square plus 20 minus 10 whole square 40 minus 10 whole square, right? That's 25, 625 15 into 15, 225. 20 minus 10, 100. Right? 40 and 30, 900. Is that correct?
Yes, ma'am.
Right? 5 plus 5, 10. 1, 4, 3, 5, 8, 9 plus 9, 18. Is it 1850?
Yes, ma'am.
Right? Divided by 3. Right? What is the answer?
616.67.
61?
616.7.
Okay. I'm going to put this.
24.83.
24.83. Right? So the standard deviation of A is 24.8. Now let me find the standard deviation of B. 25 minus 12.5 to the power of 2. Then 5 minus 12.5 to the power of 2. Minus 10 minus 12.5 to the power of 2. 13 minus 12.5 to the power of 2. Okay, what is the answer? 25 minus 12.5, 12.5, what is it?
156.25.
156.25 and 5 is 7.5, 6.25. 2.5 into 2 will be 6.25. No, this is minus 10 minus 12.5, right? So this is 22.5. 22.5.
506.25.
500
6.25.
and 30 minus 12. What? 30 minus 17.5.
306.25.
306.25. And this
1025.
1025 divided by 3.
341.67.
341. Find the under root of this.
$18.48.
18.4. Right? Now let me find the standard deviation of the portfolio. Right?
Excuse me, ma'am.
Yeah.
Then why are we dividing by 3? 1025 divided by 3.
Because when you have a sample, right, in quantitative methods, you've already taken out the mean, right? So the one observation is already taken. So that is why instead of n you divide by n. Instead of n you divide by n minus 1. If in case if I have a large sample, right, or the population sample is very large, or it's you're talking about the population. In that case, whether you divide by n or n minus 1, it doesn't matter, right? But when it is a small sample, right, to that extent you divide by n minus 1, right? Okay, now let me find for the portfolio. Okay. Five minus 11.25 to the power of 2. We have 0 minus 11.25 to the power of 2. And again it is 5 minus 11.25 to the power of 2. And 35 minus 11.25.
First one is minus 6.25. First, that comes out to be 39.06.
Okay.
Then we have
11.25 into 11.25.
126.56.
126.56.
Then again 39.06.
35 minus 11.25.
564.06.
56.
4.06.
Okay, total it up.
768.74.
768 divided by 3.
256.24.
256.24.
24.
Find the under root.
16.
16. Okay. Now, as you can see, that by combining the two securities, actually I have achieved a standard deviation which is less. Right? Now, why is this? Simply because what happens in this, if you look at this example, right? See, only in the last place, these two securities are moving together. Otherwise, when one security is moving down, the other one is moving up. So going down is going up. So going up, doing? No, right? The fact is that as long as the correlation is less than 1, as long as the correlation is less than 1, one can achieve, reduction of risk through diversification. Right? If the correlation is 1, positive 1, right? In that case, there is no benefit out of diversification. In that case, the risk will be actually the weighted average. Right? Now, the question you can ask me is that, is it possible to have a perfect positive correlation? Not possible. Right? Now, if you have negative correlation, so much so the better, because the possibility of reducing risk is far more. Right? If I am able to, have negative correlation between two stocks, right, I can achieve a much higher degree of reduction of risk. Right? Diversification becomes all the more effective. Again, the question that you may ask me is negative correlation possible? Yes? What would you say? Yes or no?
Not right. No.
Yes.
No. Yes.
Yes, ma'am.
Negative correlation. Is it possible?
Yes.
Technically speaking, yes. Right? For short periods of time, yes. Right? For example, assuming that this, the economy is looking up, right? And let's say we are in this tech phase, right? So everybody buys computers, nobody buys typewriters, right? So to that extent, the stock of those companies which are making computers will go up, and the stock of companies which is producing typewriters would go down. Right? So negative correlation is achieved. Right? Now there are two aspects to this. Why would anybody like to invest for the sake of this diversification into a company whose stock is going down?
In case of negative correlation, but there are equal chances that second security will go up and the first security will go down, and then vice versa.
Right? And the question that I am asking is, see, the computer company is the company which makes desktop computers, PCs, is going up, right? And the company which is making typewriters is going down. Right? So there is negative correlation. Right? I would say there is definitely negative correlation. Right? But from the point of anybody, right, who would like returns, right? Why would anybody like to invest in a company that is making negative returns? Nobody would like to do it. Just to achieve reduction of risk at the cost of, reduction of returns is not a feasible proposition. Second, have you ever encountered a situation where any company's share price is negative?
No.
Right? So, let's say for a certain period of time it falls down. Can this fall continue indefinitely?
No.
Right? So what I'm trying to say is that maybe for a brief spell of time, maybe months, 2 months, 3 months, right? Depending on conditions, right? We may have a situation where one company is doing well and another company may show some slight, right? And you may have negative correlation to that extent. But if I carry this, over a long period of time, it's not possible, right? Because the company goes, it is not possible to have negative, because in that case, rock bottom, it reaches rock bottom, and you can't possibly go there. So there is a downside to it. Second thing is, any case, right? See, if the company is not doing well and there is a constant slide, right? What best will happen? That let's say it reduces to 1 rupee. Right? If the company is not doing well, it reduces to 1 rupee. At some point or the other, right, the company will delist. There will be some liquidation, because you can't hold on to a debt asset. Why would the company be in under operation? Unless it is government supported or something like that. It's not likely to happen. So it's going to delist. So you possibly cannot have a situation where there is absolutely negative returns. Right? The second thing that needs to be looked at is, see, if the if the company is not aligned with growth prospects, it doesn't have any growth prospects, right? So it has no business being there. Right? You know, companies would die, right? For example, at the turn of century, there must have been some very profitable companies in the last century, right? Are all those companies in operation today? No, because companies that phase out, they will remodel, they will rechange, there will be some merger. Right? If they cannot survive the marketplace, they will just disappear. Right? And one fine day, you will not find them there. Right? So they won't be on the stock market. So there is a question of a company persistently coming down. Right? So if you are really talking about a reliable estimate of a company's correlation factor between two companies, you have to actually observe it over a long period of time, whereas in the business model of one company is juxtaposed against the business model of the second company. So if there is actually a company, for example, if you are saying, the monsoons are going up, right? Monsoons are doing fine. So let's say the automobile industry is doing well, but can you actually find me a particular stock where the economy and it will actually do badly? Is there a company? Can you name me any single company which is likely to do badly if the economy is not doing well? Right? Is there a company? If the economy is not doing well, right, if a particular, right, let's say, I would expect if the economy is doing well, virtually all the companies will do well, right? Some may do less well, some may do more well. But if the economy is doing well, then it's not likely to happen that some company is going to go in the negative, right? So possibly the correlation may be less, right? But it is more likely to be positive, right? You will not actually witness negative correlation, right? So to that extent, technically yes, I can say there is negative correlation, but practically speaking, we will not have negative correlation.
I want to ask you one thing about negative correlation. Say I'm having I'm an investor. I want to invest in Kingfisher and Jet Airways. There is a negative correlation between the two companies. For the purpose
why would there be negative correlation?
Because stock of if Kingfisher fetching a good market share, then naturally the Jet Airways gonna lose it.
It does not happen this way, right? Please understand that if a particular company is in a particular line, right? For example, if you're talking about Jet Airways and you're talking about Kingfisher, right? Now you may say that the company may gain market share at the cost of another, right? Yes. But it is not likely that you would wipe it off completely, right? Why? Because see, when the economy grows, right, and suppose the airline sector is growing, it will benefit both Kingfisher as well as Jet, right? The business model may differ, right? But in general, the performance of any stock is dependent on three factors. One, the economy; second, industry; and third is the company specific, right? So maybe Jet may have better service standards, right? But not necessarily that Kingfisher has lousier standards. So if in general people are using flights to travel, so some will prefer, right? It is not like overnight they will say we will not travel by Kingfisher at all, right? Yes, as I said, for a temporary period of time, if there is a merger or a consolidation phase, right? So what will happen is that if it's not doing too well, right, doesn't mean that there is negative correlation. Yes, if you actually plot it out, you will find correlation, but it will be positive correlation, but it will be less correlation. There won't be negative correlation. So if it is not doing well, but you cannot have a situation where one script is going up and one is going down in the same sector.
Another question, say one is of airline industry and one is of some transportation.
For example, if you are talking about airline industry, let's say suppose there is a transportation company. Yes, for example, let's say Tata runs buses.
Yes, sir.
Right? And Tata runs some private bus channel links between this and this.
Yes, sir.
Now, for example, if in economics you would have studied that there are some goods which are complementary.
Yes, sir.
Right? But most things are actually complementary, not at the cost of each other. For example, tea and coffee.
Yes,
right? They are both drinks. Right? Now, if I am having tea, I cannot have coffee. Is that the scenario? I have tea as well as coffee. I may have tea at one point of time, but at coffee at the other end. Right? So if there is a market for aircraft, there is also a market for buses. Aircraft will go from one place to another over long distances, but over short distances, you would still need bus transport. Right? So there cannot be a situation where you have absolutely something that absolute you have. It's a perfect switching that I can do
But
one
like,
in place of the other.
in case of like Kingfisher, who is in domestic, and like Reliance is having a very good domestic transportation services,
Okay.
and suddenly the air prices slash down. Naturally, like the transportation consumers will go for that airline
It still
services.
says even if you are saying aircraft prices slash down,
Yes, sir.
but please understand that there is a limited extent from here to, suppose if I had to go to, let's say, Bijnor, right? How many people do you think will use an aircraft? It's probably more effective to go by train or even bus. It's actually just maybe a 2-hour ride. Why should I use an aircraft? I go to the airport, board a ticket, and there is a price factor. I can travel by bus maybe using 100 rupees. Why would I pay 6,000 for it? Right? So the point that I'm making is that in economics we actually say that it is not possible to have something which is like in place of another. Each market has its own goods, right? Has its own want, right? So to that extent, we will not have something that we have that that absolutely there is a perfect substitute. There is no perfect substitute, right? Even for those goods which are really related to each other, right? Maybe for a single individual you may have a perfect substitute, but for the entire market, if you are saying that you can have a perfect substitute, that's not possible.
It's gonna affect. You want to say that it is going to affect, but not that much.
It is going to affect, as I said, the correlation may be less,
Yes.
but it cannot be negative. Right? Practically speaking, it cannot be negative. Right? So this is in terms of in terms of calculating the standard deviation. And there is actually a formula which you can use instead of using this and doing it, finding out the returns and then finding out the standard deviation for that, because it becomes very cumbersome to do it. So there is a shortcut formula that one uses, and the formula is the standard deviation of the portfolio. One, rate which is invested in, let's say, security A. The standard deviation of A, square of that. The rate which is invested in security 2, square of that, multiplied by the standard deviation which is invested in B, square of that, plus 2 double 1 double 2. What is the rate which is invested in security A and the rate invested in security B, and the covariance between
Yes. A and B.
A and B. Right? This is the symbol, or I think the correct symbol is actually the symbol that you use for covariance is this. Use sigma, and the subscript should be A and B. Right? So covariance can also be written. It can be broken up into correlation between A and B into standard deviation of A into standard deviation of. So if you would like to try the various estimates that we had done earlier, right? If you found out, for example, the expected return of security A was what? First was 11, second was 11.25. What was the average of A? Expected return of A?
Plus 10.
10. This average of A was 10. Of B was 12.5. 12.5. And standard deviation of is 24.83. Standard deviation of B is 18.48. And we've done 50% in both?
Yes, ma'am.
Why not? Okay, we've not calculated covariance. Right, so it will be difficult to do this. But if we had calculated covariance between the two securities, we would have been able to figure out the standard deviation without going through the process. Right? But of course, you need to find out covariance.